Bitcoin and the IRS, what you must know. Do you think that Bitcoin or other cryptocurrency is invisible to the IRS? Think again. Sometimes when I'm on social media and the topic of Bitcoin or cryptocurrency, I'm going to say Bitcoin from now on, but it applies to all cryptocurrencies, is people will say, I've taken it and I put it in a secure wallet. Nobody will ever know about it. There's no way they're ever going to find out. And I'm just here to tell you that Bitcoin is treated like any capital asset. It's treated as any other form of property. So just like stock, every transaction is taxable, and you will have a basis, and then you'll have a sale price, and that will either have a profit or a loss. So recently, last year, I went to El Salvador. I know it was crazy. It was a last minute thing, but I went to El Salvador to visit because I wanted to see if Bukele was as bad as they say he is, and I wanted to see if the country felt safe. Side note, the country did feel safe, had a great time. Not a lot of tourist infrastructure in El Salvador, so we might have to wait on that a little bit, but the country is beautiful, people are nice. But the reason I brought up El Salvador is Bitcoin is actually an official currency in El Salvador, and I have a little bit of Bitcoin. And I thought about paying for little things like meal at McDonald's or whatnot with Bitcoin. And then I thought again, oh no, if I use Bitcoin like that as currency, like some could argue it was intended to be used, then I have to track my basis, and then I have to put it on my tax return next year. It's just way too much trouble to spend $12 at McDonald's, so I didn't do it that way. So when is crypto or Bitcoin taxable? When you're selling for cash, trading for another coin, or using it to buy goods and services, anytime it gets liquidated from one cryptocurrency, so Bitcoin into Ethereum or into US dollar or US dollar coin or US dollar fiat, anytime there's a change of its form, it's going to be a taxable event, or at least a reportable event. So you have to track your basis in what you spent for the Bitcoin. And most people that I see, it's not really that big a deal because they'll buy X portion of a coin and they know what they have. Where it becomes problematic is we have lots of trades. So example, you're doing the fundamental equivalent of day trading in crypto. That can be really problematic. You also need to know what are capital gains, and is it the difference between long-term and short-term capital gains. So if you've held the asset for a year or more, it's considered a long-term capital gain. If you've held the asset for less than a year, it's considered a short-term capital gain. What's the difference? A short-term capital gain is taxed at your ordinary tax rate. So if you're really successful and you're being taxed at a 35% tax rate and you're playing around with a lot of Bitcoin, then, and it's all short-term, you're going to end up paying 35% on your gains because they're considered short-term capital gains. Long-term capital gains starts at a 0% rate. If you're low income, goes to 15% and then up to 20% as a max. So if possible, you're always going to want to make sure that you participate in long-term rather than short-term capital gains. Talk about crypto mining and staking a little bit. These are treated as income at the fair market value when received. So if you're crypto mining and you create, let's just say a Bitcoin, I know that's not very likely, but let's say you created one Bitcoin, you're going to have to pay tax based upon that amount or that value at the time that you received it. 1099 reporting. So exchanges are now issuing forms to both you and the IRS for your cryptocurrency trading. I think this is generally a good thing. I've been doing this long enough that stock brokerages did not used to issue 1099s. They do now. The nice thing about those 1099s is they will often have the basis on the 1099, and that's very helpful. There's also a question on page 1 of every tax return now, on every Form 1040, and it's, did you receive, sell, exchange, or otherwise dispose of digital assets? Might seem like a throwaway question, but it's really not. It's really important. If you have received, sold, exchanged, or otherwise disposed of digital assets during the course of a year, that you check yes to that box. Because if you check no, and then you don't report it, it's gonna look like fraud, especially if it's a significant amount of money. What are some common mistakes? Assuming that small or peer-to-peer trades don't count, or you're forgetting about fees that you spent to do the trades. So just remember those things. Even if you're trading crypto from you to your buddy, that's going to be considered a sale. Record keeping is critical. I've talked about basis a bunch of times in this video already. but you're going to want to track your basis, your dates, and the amounts. And you can use crypto tax software if you need to. I would suggest that you use one similar to Coin Tracking or Coin Tracker. Those are both very good. I've used those in larger cases. Now, if you just bought $500 worth of crypto and you sold it for $1,000 and that's all there is to it, you probably don't need that software. But if you buy, sell, you're going to need software in order to track that basis. There are penalties for non-compliance. We're starting to see letters go out to people who have crypto assets and have not reported those. I would anticipate there's going to be a huge increase in crypto audits going forward. I have actually participated in one crypto audit so far. It was a few years ago, maybe 5 years ago. We ended up having a no change audit or no significant change. I can't remember. I think there was a couple $1,000 change, but it had nothing to do with the crypto assets. It was some other questions that weren't handled quite correctly. But in this case, the client actually had tracked their basis quite well and reported it quite well. The thing I enjoyed about that audit very much was it was my first crypto audit and it was the auditor's first crypto audit. And when I asked him some questions about it, he said, I don't know. There's one guy in Washington, D.C., and I'm going to have to check with him. He's our expert. I thought that was pretty interesting. But remember, that was 5 to maybe 7 years ago. I'm sure they've caught up a lot since. Planning strategies. You're going to want to make sure that you harvest loss and that you hold over a year so that you can participate in long-term capital gains whenever possible. You're going to want to make sure you keep nice, clean records. If you're trading on an exchange, it probably would make sense to me to only trade on one exchange. Don't trade on Coinbase, Robinhood, and every other exchange. Try to keep it with one. That way your records will be a little bit easier to track. Just remember that crypto isn't hidden from the IRS. They're going to become more and more sophisticated at finding your crypto. I anticipate we're going to see some lifestyle audits, especially of bigger crypto holders, where they're not reporting their crypto, but they're living in a Miami penthouse and they're driving a Lambo, a Ferrari, and a Porsche GT3, and there's no discernible reportable income that could support that lifestyle. I would imagine that you're going to get some audits on that kind of behavior. And after those audits, there might be people going to prison because they're going to need to make some examples of some people so that the rest of us are scared into compliance. Just remember, again, the crypto isn't hidden from the IRS, and if you stay compliant, you can protect your profits. We all know there's incredible profits to be had in cryptocurrency, but let's follow my old saying, and that is that pigs get fat and hogs get slaughtered. Don't act like a hog. Report your crypto gains, pay your long-term cap gains, and then you can live in peace. Hopefully this has been helpful. Thanks for watching.